Businesses are collapsing, but rather than give you hyperbole, I want to show you actual facts and statements made by companies over just the last few weeks, so you could see what's actually happening at all small, medium, and large businesses. And here's why this is important. A few weeks ago, course members and I reviewed what was likely going on at casinos in Macau. And sure enough, when we started noticing that VIP customers were attending Macau casinos substantially less, casino stocks subsequently fell. Now, this is the kind of information, these are the kinds of heads up that we want to know. There's some folks, some people in the courses who started shorting some casino stocks and they made some good money off of doing that. Now, best wishes for them, and this video isn't to give you financial advice, it's to talk about some of the red flags that we're seeing at businesses, because not only do they affect businesses, but they affect the broader economy. Now, maybe they'll affect the broader economy in a good way, because if businesses slow down, as long as they don't go bankrupt, then maybe the Fed can stop beating us over the face with ultra high interest rates. But let's go into some of the actual data. First, let's start with a company called Bill.com. Now, they serve a lot of small to medium businesses. And what's interesting about Bill.com, and just to give you a quick preview, we'll also be talking about things like Shopify, Intuit, Nike, and plenty of other companies, okay? But just briefly on Bill.com. They are a SaaS business that basically help individuals and businesses pay their bills. You input your little bill, you hit pay, and they mail the check for you. They make it really easy, and then they can sync up with your books and stuff like that. Great, fine. But their company has been projecting a 30% growth estimate. Now, they're down about 45% year to date, and they're projecting that they're going to grow by 30% starting July 1, but that could be a little optimistic because we're starting to see an inflection point in people's desire to actually download the app for Bill.com. Now, this ends up becoming a red flag that we're going to see consistently at other businesses as well. So let's go ahead and start here. This is the Bill.com monthly downloads for their app. And you can see we're in about month 10 right now. Remember, it's October, that's month 10. And look at this plummet right here that we're getting in downloads. That's a substantial plummet when we're expecting to see potentially 30% growth. Like, look at the growth we had in 2021 right here, this white line. We're not actually seeing that anymore. But according to estimates per Bloomberg, we might actually be seeing a decline. And that's not that great. When we start seeing a decline like that at Bill.com, we wonder, okay, well, how are other small businesses doing? Oh, so this is the Bill.com business payments app. Here's the Invoice2Go app, also showing a substantial decline. But it's not just companies like Bill.com, it's even payroll providers. Here's an example of ADP Mobile Solutions. Now, how many people actually have to download the app for this one is kind of questionable because they're a payroll service. Most people are going to do this through a computer, right? But, I mean, we had to let somebody go yesterday. Now, we're looking to hire somebody else, but the more people you let go, the more or the less you need payroll services, right? So if businesses are starting to let people go, then maybe they have less of a need to use the ADP payroll businesses or services, especially if they're going from, maybe a single founder and one employee to no employees. You see that a lot during recessions, right? Businesses become a lot leaner. They cut every bit of fat that they can. So, now, for my personal business, we're actually hiring a replacement, just the person wasn't a right fit, but that's okay. That's what you need to do. If somebody doesn't fit or they're not productive, then you have to replace them with somebody who's actually willing to work. Anyway, so here's a company that typically grows at about 6%. However, the app downloads are now down 33% year over year and 26% quarter over quarter. Again, you're seeing that inflection point that's really started in September, which is quite interesting. So you're really seeing this decline. Here's another one, Credit Karma. Now, I thought this was interesting because we can kind of get a little bit of data into Intuit. So Credit Karma, I actually think is a pretty decent app for checking what your credit score is and seeing if you can improve your credit score. Honestly, I only use it for checking what my credit score is, although I even rarely do that. But look at this decline in usage that you're getting at Credit Karma. Now, you do tend to have every single year, the different lines here are different years. For some reason, it seems like people are more motivated to check their credit at the beginning of the year compared to the rest of the year. But you're actually seeing these declines that take you back almost lower than 2020 trends. So it makes you wonder, are consumers like, all right, I'm just done trying to build my credit, or like maybe I've already maxed out my credit cards? I don't know. It's kind of interesting. We're definitely seeing some inflection points. And it's not just some of these businesses, it's some of the earnings calls we're going to look at as well in just a moment. Here's QuickBooks. QuickBooks accounting service. Also lower than any prior year in terms of monthly downloads. Here's MailChimp. This I thought was like a crazy one, because one of the first things that small and mid-sized businesses do, in my opinion, is they cut discretionary spend for advertising during a recession. So for example, if you're paying MailChimp $2,000 or $3,000 a month, which I know that sounds like a lot, but for a business, that's actually pretty common with, you know, mailing lists of say 30, 50, 100,000 emails. That's not uncommon. And we use mailing lists as well, not only for accredited investors who are looking to join HouseHack and helping provide them updates, but also other individuals for other businesses. And this is a substantial decline in the number of downloads here for MailChimp. I mean, really huge estimated decline. And these are just estimates, right? So we're trying to look at forward-looking data. Well, I mean, I guess we're looking at a data snapshot of what's happened over the last 30 days, but the numbers haven't officially come out yet. So to some extent, they're kind of forward-looking. Here's Customer Hotspot CRM. I mean, this one's a little harder to read because like they're doing so much better in 2022 as a customer resource manager as in other years. And there does seem to be a sort of a decline towards the end of the year. So I'm not so terribly worried about this one here. But you do see that in general, small and medium businesses are seeing their stocks substantially decline, more so than even like the larger cap companies in the NASDAQ 100. Now let's look at some actual earnings calls here. So let's look at Shopify for a moment. Some of the things that I noticed in Shopify is that they're talking about here a rapidly escalating prices for essential goods and energy, and consumers have been favoring discount retailers and reducing their spend on other goods categories. So we're seeing less discretionary spend and more necessitated spend. And Shopify is talking about this as a risk factor, right? At the same time, the New York Times is reporting that Shopify, as of October 4th, is conducting a hiring freeze for all positions, for store positions, physical, online, retail, and logistics. FedEx froze hiring. So what does this tell you about the consumer? You're seeing a real slowdown here, and Shopify now talking about this idea of getting more rigorous reviews of our workforce done through the organization with the aim of more fully maximizing our team's performance. So what you're saying is like the company got fat and lazy, right? So when you actually look at some of these numbers, this is a little messy, so I'm just gonna kind of give you the bottom lines here. But their revenue grew 15% in the last 3 months. It grew 18% in the last 6 months. So you actually have a decline in the rate of revenue growth at Shopify. But not only do you have a decline in the rate of revenue growth, but you have like the worst combination to go with that. Your operating expenses were growing at 71%, which that already is insane. Like your operating expenses grew 71% and your revenue only grew 18%. That's terrible. That's in the 6-month ending period. But you go to the 3 months, so the more recent period, your OpEx actually went up 75% while your revenue only went up 15%. Like it's getting worse. Like that's not good, right? Here's Shopify as well. Originally, they thought the level of orders that they were going to have were going to be higher than in 2019, but the rate is actually lower than what they had planned for. So in other words, you're seeing this sort of, as they say, a recalibration, not necessarily to online. Like they thought everybody was just going to go online all the time. People are shopping in stores again, and e-commerce is trending back to a normal growth curve, is what they say here. A normalized growth curve, not a curve that's actually higher than where it used to be. Now, maybe that's because of the recessionary dynamic. There are some arguments that more people are going to stores because they think they can get better deals at stores, because when you're in a store, the theory is that you're a more captive customer than when you're online, and like, if a store is going to close you, that's the time to close you, right? And when I say close, it's like, hey, like if you're getting ready to buy a home, like what can I do to get you to sign that contract? You know, maybe like I lean over and I just happen to drop the pencil or pen next to you, and then when you pick it up, it's like, just sign. You know, I like closing, right? Sales. Anyway, so but some people think that that's easier to be done in person than inside or online, right? So as a result, sometimes people think you get a better deal in person, and maybe that's why we're seeing some of that move. Now, there's some, let's see here. This one is talking about some headwinds here. Oh yeah, so this is Cracker Barrel. Now I know this sounds crazy because they appeal to a lower income demographic. I, by the way, didn't know they serve beer and wine. I thought that was kind of interesting. But they're talking about softer consumer demand, higher costs, and this was a bad one, uncertainty about when these will abate. So it's kind of like businesses are uncertain about when the inflation's gonna go away. At the same time, you're getting less demand. I had a course member this morning in the course member live stream. They were talking to me about their small business, and they're like, Kevin, we have seen no reduction in inflation. Like, people keep talking about this idea that commodity prices are coming down. That's it. Peak inflation is behind us. But like, our costs are still rising. So like, please give us some of the deflation, but we're not seeing it yet. And so I always love dialoguing, obviously, with all y'all in the course member live streams. And remember to join those before Friday at 11:59 p.m. We are getting rid of the lifetime access for people who join after Friday, specifically with the Path to Wealth course. But if you join any of the courses before 11:59 p.m., you'll have lifetime access to all the content in the courses, with the new content or whatever, and the live streams. But anyway, going back to this over here, you know, when you have Cracker Barrel, okay? Like, they're known for being cheap. They're known for being like your rest stop food. That might be offensive to rest stops. Anyway, they're talking about value perception. Like, what? Here you go, Carnival Cruise Lines, okay? Carnival Cruise Lines, I wrote this down. In 2019, they had $3 billion of net income. Now, okay, here in 2022, they're literally spending $1.7 billion on interest. They had $200 million of interest expense back then. That means they're spending 8.5 times what they used to on interest. They're literally spending somewhere around $4.7 million a day in interest because they're getting reamed by high loan costs. Even Nike's freaking out, talking about doing more accelerated liquidation and tightening our inventory buys. In other words, we don't need to buy anymore because we got enough. Now, at the same time as inventory piled up, demand plummeted, and now they're accelerating clearance activity. Like, then you got AMD, and obviously the PC market got destroyed, but look at this. When AMD tells you that there is a significant inventory correction across the PC market, and shipments for processors, down due to a weaker than expected PC market and significant inventory correction, that's bad. So that's, it's just like, let's try to understand this. All of the things that I'm putting together here are actually, like, in a really like perverse way, somewhat good news, because in a perverse way, businesses suffering and panicking actually is like music to the ears of the Federal Reserve. You know, they're probably looking at this video because I know they watch every single one of my videos, because who wouldn't? You should subscribe, by the way. Just kidding. Anyway, so, you know, I'm sure they're looking at these earnings reports one way or another, and they're like, good. Like, this is the point. This is what we're trying to accomplish. We are trying to make businesses feel lean, so they stop hiring as many people. And if they stop hiring as many people, then wages go down and wage growth goes down, right? This is a sign of pain that we're seeing. And so it's actually good news for macro purposes of, you know, the Fed's policies are finally working. It's just bad news in the meantime for some of these companies' earnings. Now, you know, I know over the past few weeks it hasn't done well, but that's probably because of the Twitter overhang. But this is one of the reasons I'm actually a big fan of seeing Tesla as maybe to some extent like an American Express or even a Lululemon, because they don't have some of these red flags yet. But to some extent, Tesla is so fascinating because we know that no matter how many vehicles they produce, we expect them to sell them. I guess I can't say we know, but Goldman Sachs, for example, conducted a report themselves, and they're like, hey, we think Tesla's going to get to 1.9 million vehicles by the end of the year of 2023, and they're going to sell all of them. And I believe that. Now, you know, that's a slightly slower growth rate. That's off the 50% growth rate. That's down to like 35% growth rate. So, you know, that can compress the stock a little bit. But the point is, there are a lot of companies that are on the earlier phases of their growth curve where they're not going to see that EPS decline unless you have like temporary like foreign exchange impairments. Like with Tesla, I think you could see $1 billion foreign exchange impairment. But otherwise, their EPS should grow substantially. While a lot of these other companies like Nike, they're going to be in an earnings recession. You're going to look at their earnings per share thinking they were a value company, and then they turn into a value trap because it's like, oh no, EPS is declining. Or you look at Shopify, which is a company that sells for at least a somewhat rich multiple, and all of a sudden you look and you go, oh, wait a minute, you guys are actually losing a substantial amount of money, and you're spending a lot more, but your growth just isn't what it used to be. At the same time, and I tweeted this, I don't know if anybody actually cares about this, but I'll say it anyway. I tweeted that, Shopify, it seems like they're cutting back on their customer service, and I wonder if that's because they feel a little bloated. But yeah, look at their loss here. This is a loss in hundreds of US dollars. And here we had a loss of about $1.2 billion. That's insane, $1.2 billion. In the last 6 months, they lost about $2.6 billion. And why is that happening? Well, it's happening because their gross profit in the last 3 months was $655 million, but their OPEX was $845 million. So you get this massive, like operating expense here to where you're actually negative from operations. And then on top of that, you take off, you're taking off $1 million for another expense. This is like write down in ownership of I think it's Affirm stock. They got a lot of Affirm stock, so they took a massive write down over here. But even if you forget this sort of other massive loss that they're taking over here, they're still losing money on an income from operations point of view this year, which last year they were making money on an income from operations point of view. So now you have infinite multiples, and you're kind of taking this turn for the worse. Again, good for macro, but bad for some of these individual businesses. Keep in mind, if you want to, take advantage of this sort of analysis that I do on a daily basis, like today we did Generac in detail, and we kind of chat about it together. Join those courses. Whether you're interested in just the live streams, you get lifetime access with any of the courses until Friday, 11:59 p.m. And if you just want to learn the lectures, Zero to Millionaire Real Estate Investing, the Stocks and Psychology of Money. We even talked stock psychology this morning. It's really, really important, especially in times like these. So anyway, check out those programs, link down below. Thanks so much for watching. We'll see you soon. Thanks, bye.